Hello, everyone. Welcome to Finance Focus. You did the right thing, you know. You listened to the advice. You built an emergency fund. 3 months, 6 months, maybe even 12 months of living expenses. You put that cash into a savings account at your big familiar bank. Marble columns, friendly tellers. You look at your statement, see the balance, and feel a sense of security. You're prepared for a crisis. You're responsible. But I'm here to tell you that this feeling of safety is a dangerous illusion. Your money is quietly and constantly losing its power. Every single day, it is shrinking. Let's get brutally honest for a moment. That emergency fund is not an investment to make you rich. It's a safety net, insurance against life's curveballs, job loss, medical emergency, sudden car repair. Its primary job is to be there when you need it, ready and accessible. Let's pull back the curtain and look at the two culprits responsible for robbing your emergency fund. Historically low interest rates at traditional banks and the persistent corrosive force of inflation. These two forces are creating a perfect storm that erodes your wealth without you noticing. Understanding how they operate is the first step. You don't need a PhD, just a few simple truths the industry hopes you ignore. They profit from your confusion and inaction. Today, that ends. Central banks kept baseline rates near zero for years to stimulate activity. Big banks have been slow to pass any benefits to savers. They have little incentive. Most people won't move their money. Those few dollars compound into thousands. Banks count on your apathy. Your bank pays 0.1%. Inflation is 3%. Real return equals 0.1% minus 3%. That's negative 2.9%. On $20,000, that's $580 of buying power lost this year. Over 5 years, that's thousands gone. This isn't an accident, it's a feature of the system. The good news, you don't have to be a victim. Simple, safe, readily available alternatives can put you back in control. If you're going to do just one thing after reading this essay, this should be it. The single easiest and most impactful step: move it from a pathetic, low-yield savings account at a traditional bank to a high-yield savings account. This is the lowest hanging fruit in personal finance, and it's an absolute no-brainer. These accounts are designed to pay you significantly higher interest without sacrificing safety or accessibility. Most high-says are from online-only banks. With lower overhead, no giant branch networks or massive ad budgets, they pass savings on as higher APY. While your local branch might pay 0.01%, reputable online banks often offer 3%, 4%, or even higher, depending on the rate environment. Literally 300, 400 times more interest. Be crystal clear, HISAs are typically FDIC insured up to $250,000 per depositor per bank, same insurance as big banks, zero additional safety risk. Opening an HISA takes about 5 minutes. You'll need your social security number and a linked checking account. Transfers are a few clicks, typically 1 to 3 business days back to checking. Keep 1 month's expenses in checking for instant needs and park the rest in the HISA, earning a real return while it waits. Stop making excuses. This is a simple, powerful move you can make today. Once you've grasped the power of moving your money out of a lazy traditional savings account, you can explore similar options. A close cousin to the HISA is the money market account, a deposit account, not a money market fund. It's FDIC insured like savings and checking. MMAs blend savings-level yields with checking-style access, often with check writing or a debit card, rare for HISAs. If your water heater bursts and payments due now, an MMA can let you pay immediately instead of waiting 1 to 3 days for a transfer. Do check terms. Some banks still limit transactions, set higher minimums, charge fees, or use tiered rates. Compare the best MMA versus HISA for your needs. Decide which matters more, slightly more accessibility, or a slightly higher rate or lower minimums. For many, an MMA's flexible access makes it a strong emergency fund home, so long as you don't use it for day-to-day spending. As we move along the spectrum, we come to certificates of deposit, CDs. You trade a bit of liquidity for a higher guaranteed return. A CD locks your rate for a fixed term, 3 months to 5 years or more. Open a 12-month CD at 5.0% APY, and you're guaranteed that rate all year. CDs at banks are FDIC insured up to $250,000. Withdraw early and you'll likely forfeit several months of interest, often 3 months on a 1-year CD, so not ideal for immediate cash. Use a CD ladder. Split the money into staggered terms so a portion matures regularly without penalty. As each matures, use the cash or roll into a new 12-month CD. You capture higher yields with predictable access windows, an elegant middle ground between flexibility and guaranteed return. For the absolute pinnacle of safety, nothing surpasses U.S. government securities. For the portion you want ultra-protected, T-bills are outstanding. Buying a T-bill is lending to the U.S. Treasury. With taxation and printing power, default risk is considered virtually zero, often called the risk-free asset. Bills mature in a year or less and are sold at a discount. Buy for less than face. Get face at maturity. The difference is your interest, often state and local tax exempt. Buy direct at Treasury Direct, free but clunky, or via brokerages, which are easier and allow secondary market sales if you need cash early. That tradability provides liquidity, CDs don't. Short maturities mean low price volatility. Create a T-bill ladder, stagger maturities so part of your capital matures regularly, giving a steady stream to use or reinvest. You capture government-level safety and tax perks with predictable liquidity. Of all your options, one is engineered to combat inflation, Series 1 savings bonds or I-bonds issued by the U.S. Treasury. I-bonds pay a fixed rate for life plus a variable rate reset twice a year based on CPI. That dual rate structure is what makes them powerful. When inflation spikes, I-bond rates spike too, preserving your spending power, often out-yielding top HISAs and CDs during high inflation periods. Backed by the full faith and credit of the U.S. government. Safety like T-bills. Limits. Up to $10,000 per person per year electronically via Treasury Direct, plus $5,000 with a tax refund. Liquidity. You cannot redeem in the first 12 months. If redeemed between year 1 and 5, you forfeit the last 3 months of interest. After 5 years, no penalty. Because of the lockup, I-bonds belong in the middle or long-term layers of your emergency fund. Unparalleled inflation protection for money you won't need for at least a year. Knowing the options is one thing, taking action is what separates the successful from the frustrated. Stop passively watching your money shrink. Build a dynamic, resilient emergency fund. Use a tiered approach, immediate access, better returns, and safety. Step by step, start today, no more excuses. Step 1, calculate your target. Tally essential monthly expenses. Rent or mortgage, utilities, groceries, transportation, insurance, minimum debt payments. Exclude discretionary spending. Aim for 3 to 6 months if employment is stable, 6 to 12 if income is irregular. Example, $4,000 per month times 6 equals a $24,000 target. Move 1 to 2 months of expenses, $4,000, $8,000, into a top-tier HISA or MMA. Choose FDIC insured, no fees, highest APY. This alone can boost returns 300% plus overnight. Allocate the next 2 to 3 months of expenses into a CD or T-bill ladder for higher, guaranteed or market-driven yields with staggered liquidity. For example, buy 3, 6, 9, and 12-month CDs or T-bills, $3,000 each, locking in rates and liquidity intervals. Put the final $4,000, $8,000 into I-bonds via Treasury Direct. Funds are locked for 1 year but designed to preserve purchasing power. Tiered system equals liquidity plus yield plus inflation protection, built to serve you when it matters most. You now have all the information you need. You understand why your current setup is failing you. You have a clear blueprint. The obstacle isn't knowledge, it's action. It's easy to read, nod, and think, that's a good idea. I'll do it someday. But someday leads to stagnation. A rich life is built on decisive action. The time for deliberation has passed. You don't need the perfect HISA that pays 0.05% more or 3 weeks of ladder research. Perfection is the enemy of progress. Get 85% of the way there, now. The difference between 4.5% and 0.1% is monumental. between 4.5% and 4.55% is trivial. Focus on big moves. This week, complete 2 tasks. First, calculate your target emergency fund number. Second, open one high-yield savings account. Find a reputable one with a great rate and complete the application. It'll take less than 10 minutes. As soon as it's open, transfer at least 1 month of expenses from your old lazy account into the new powerful one. That's it, your first win. You'll see higher interest hit and feel momentum. Automate the rest. Your emergency fund is your shield. Reinforce it. Start today. Thanks for watching. Don't forget to subscribe for more amazing videos.